Ron Barron is a strong Tesla bull and has been profiting from Tesla's success for some time. While he has sold some of his shares of Tesla for specific reasons, Ron Barron reveals why you should never sell your Tesla stocks. Tesla has been going strong, and in 2021, the company posted some great numbers and asserted itself as the major electric vehicle maker in the market. The company's success has been translated to its stock price, and today we take a look at what Ron Barron has to say about all of it. Why has Ron Barron sold some of his Tesla shares? Do I need to sell some of my Tesla shares too? We will answer these questions and more in today's video. Ron Barron discussed many essential components of Tesla's business and why the company's stock is worth investing in for the long term. He discussed what he believed were the most significant short-term risks that Musk's companies face. Barron's investment firm Barron Capital is currently among Tesla's largest long-term shareholders. According to the investor, the firm currently holds nearly 6 million Tesla shares and at a cost of ownership basis at 42 cents each. Even after reducing his Tesla holdings, Barron has a whopping 41% of his largest funds invested in the car maker's shares, making him the world's greatest Tesla bull. This big wager has also nearly doubled Barron's net worth since March of 2020. Two of Barron's 17 funds in particular are substantially invested in Tesla. Last year, the $7.3 billion Barron Partners Fund, which Ron Barron co-manages with his son Michael, returned about 150%. In addition, Tesla accounted for 47% of its assets by the end of 2020. Despite reducing its stake in the automaker, the stock still accounted for a sizable 41% of assets. The Barron-focused growth fund, which Barron co-manages with his other son David, has $671 million in assets and returned 122% last year. It has decreased its stake in Tesla from 39% at the end of 2020 to 32% as of March 31st. Tesla has been the most significant investment I've ever made, adds Barron. According to records, Barron Funds was the 12th largest stakeholder in Tesla at the end of 2020. Barron Funds had the greatest percentage of its entire portfolio committed to Tesla, with 12% among the carmaker's top 50 biggest institutional shareholders. Other significant investors include Edinburgh, Scotland-based Baillie Gifford, which owns 11% of its portfolio in Tesla, and Cathie Wood's ARK Invest, which has 8.3% of its portfolio in Tesla. According to Barron, he began developing his firm's stake in Tesla in 2014, 4 years after the company went public, and grew it by 2016, investing a total of $387 million at an average cost of little more than $43 per share. Since then, he hasn't contributed to the position. Barron's riches have risen in parallel with the success of his fund's bet on Tesla. According to Forbes, his net worth has increased to $4.5 billion, up from $2.3 billion in March 2020, owing mostly to Tesla's rapid 72.8% climb in the previous year. Barron Capital has made approximately $54 billion in profits for its clients, with about $6 billion coming from the firm's million-dollar investments. In a recent interview, Ron Barron extolled Tesla CEO Elon Musk, saying, "There wouldn't be electric cars if it weren't for Elon Musk." We understand why Barron praises the electric vehicle maker so much, but there's something else we learned from Barron's recent interview. The legendary investor was asked what he believes is currently the biggest risk Elon Musk and his companies face. According to Barron, Musk's health is the most significant short-term risk simply because the CEO tends to work extremely hard. This was logical given Musk's aspirations, but his health may be a factor that harms Tesla and SpaceX if it takes a hit. As much as he's healthy right now, Elon Musk deprives himself of sleep. He works a lot and sleeps 5 hours a day. He works 19 hours a day. Earlier in 2021, Barron predicted that Tesla shares would reach $2,000 per share over the next 10 years and $1,500 per share by 2024. Tesla stock has come a long way from its inception in May 2010, and many investors believe in Elon Musk. The risk variables that influence the price of a share are mostly determined by investors' attitudes toward the issuing firm. Expectations regarding the company's outcomes are one of the most crucial elements influencing a stock's price. The demand for Tesla shares on the stock exchange is determined by analyst forecasts of the company's profitability. A company's market worth can also be increased by the assets it holds, such as a patent, a real estate portfolio, or sales exclusivity. When it comes to risk concerns, innovation also plays an essential part in a company's performance, so there's a lot to consider. Stock market forecasts and prices are also impacted by the level and predicted development of interest rates. After all, with low interest rates, investors would be willing to take more risks to earn larger returns and have easier access to the stock exchange. The sector's image will negatively impact a healthy company in a difficult sector on the market. We're talking of the financial values that have become much less credible after the 2008 crisis, and the value of Tesla's shares on the stock exchange can also rise or fall due to a radical change that the sector is experiencing. A new product's debut or new customer habits are examples of things that might influence the evolution of a share's value. Another good opportunity is sector consolidation. Acquiring other companies in the same sector can establish a company as a market leader and occupy a dominant position there. While Tesla is currently the leading company in the electric vehicle manufacturing industry, it remains unknown if this will continue in the coming years, especially in a market where many other brands are also strongly producing their electric vehicles. One thing is sure. Electric cars are the future and a rapidly growing segment of car sales. But in a broader context, the general evolution of markets can increase or decrease the value of a security. For example, in gloomy markets such as those experienced during the 2008 and 2011 financial crises, even healthy and promising values were sucked downward when there was fundamentally nothing wrong with them. During periods of euphoria, the entire market participates in the increase without being economically justified. Due to positive or worrisome macroeconomic fundamental happenings, major economic and political movements can wash a whole market up or down. Investors are more likely to be reassured or worried by a country's fiscal, budgetary, and especially monetary policies. Take a look at the Chinese stocks recently. With multiple rules being enforced by the government, tech firms are anticipated to be the most affected. Yet, there is uncertainty if the Chinese government would want to harm its local electric vehicle manufacturing enterprises. Consumer habits, as with the Tesla stock prediction, can also play a role in the potential evolution of a stock price. Some opportunities are cyclical. For example, certain sectors that have had to implement restructuring can break out of a cycle of less growth. Other chances are structural. For example, firms involved in education, as developing economies migrate from an agrarian to an industrial and service culture. If there is a structural need to reform the educational system, there may be a great demand on the stock exchange for these enterprises. Therefore, all of these risk factors must be approached and analyzed correctly by the investor. Tesla appears to have traversed most of these risk factors, which could explain why Ron Barron believes that the only short-term risk is Elon Musk's health, even though the entire world suffered from the economic effects of COVID-19. As a result, Tesla announced a 71% increase in car production in the fourth quarter compared to the previous year. Most people felt Tesla's aim of manufacturing 500,000 vehicles by 2020 was practically unattainable. Yet, the California automaker nearly met its objective by producing 499,647 automobiles by 2020. The shares also reached an all-time high on November 4th, 2021, when the closing price was $12,030, and the company continues to do everything possible to push its stock price higher. For example, Tesla plans to grow aggressively, increasing deliveries by more than 50% each year over a multi-year horizon. Production facilities in Berlin and Austin are planned to start by the end of 2021 or beginning of 2022, and they're projected to increase near-term growth. So there's a lot to look forward to with this electric vehicle producer. So far, 2021 has been less profitable, while the market is off to a strong start, with stock indices reaching record highs amid excitement about the company's reopening. Many investors are skeptical, owing to ongoing concerns about the epidemic and rising inflation fears. Following a more than seven-fold increase in value last year, Tesla shares suffered in 2021, falling 8.5% in the first quarter ending in March 31st. During the same time, the Barron Partners and Barron-focused growth funds returned a minus 0.44% and 0.02% respectively, behind the S&P 500's gain of nearly 8%. What do you think of Ron Barron's take on Tesla? Comment down below.